Hi, my name's Christian Waldegrave, Head of Research at Teekay Tankers, and this is our tanker market update for December 2018. While the tanker market is exiting the year on a high note, we've seen very high tanker rates across the board in recent weeks. We've seen VLCC rates as high as $50,000 per day, Suezmaxes as high as $40,000 a day, and we've seen Aframaxes above $30,000 a day on some routes as well. And just in the last couple of weeks, we've also seen a recovery in the product tanker market, which has really lagged behind the crude in recent months. And it's been very encouraging to see LR2 rates up above $30,000 per day for the first time in 3 years. So we're now seeing strong rates across all sectors, crude and product. And these high rates are really a factor of high oil production in different parts of the world. We've seen record high oil production in recent weeks from Russia, record high production from Saudi Arabia as well, and also from the United States. So we've seen a lot of production from these countries, a lot of export cargoes. And also Iranian crude oil exports haven't fallen as quickly as we would have thought, and that's because the US granted import waivers to 8 countries to allow them to continue to import Iranian crude for a period of time. So we've seen very high oil production that's translated into a lot of cargoes, and that's what's really driven the recovery in rates in recent months. We also have seen very low fleet growth this year as well. Due to high scrapping, the tanker fleet, it looks like will only grow by about 1% in 2018. So that's well below the long-term average. And again, that low fleet growth coupled with the high oil production and the increase in cargoes is what's driving the rates. However, this recovery in rates that we've seen does come at a price. And last week, OPEC announced that they're going to cut oil production by 1.2 million barrels per day starting in January. And that's a 1.2 million barrel per day cut from October base levels. And oil production was a bit higher in November, so that means their actual cut is probably more than 1.2 million barrels per day. Now 0.8 million barrels a day of that cut will come from OPEC and 0.4 from non-OPEC partners such as Russia. We would expect that Saudi Arabia will probably shoulder most of the cuts for OPEC, and that will lead to a decrease in cargoes out of the Middle East as we go into Q1 and Q2. It will probably be in the order of about 10 to 15 fewer VLCC cargoes. So that's obviously going to be a bit of a negative for VLCC demand going into Q1 and Q2, which will then put further pressure on the Suezmaxes. And if Russia cuts as well by 0.3 million barrels per day, then a lot of that reduction will come from the Black Sea and the Mediterranean, which has really been a strong market in the last few weeks for the Aframaxes and Suezmaxes. So a cut there could mean lower demand for Aframaxes and Suezmaxes in the Med-Black Sea region. And also, I think there'll be a bit of a seasonal impact as we go into Q1 and Q2 as well. We always see a seasonal impact from refineries going into maintenance. And we think refinery maintenance could be pretty heavy next spring as refineries start to do their turnarounds and get ready for IMO 2020. So that combination of seasonally lower demand, a heavy refinery maintenance season, and the OPEC cuts will probably have a negative impact on tanker demand and rates going into Q1 and Q2 of next year. But I think it's important to note that the situation this time with OPEC is a lot different to what it was 2 years ago. This time 2 years ago, OPEC announced cuts of 1.8 million barrels per day. And that was a very steep cut that they kept in place for 18 months in order to bring down oil inventories and support crude oil prices. This time around, the oil markets are a lot more balanced. In fact, global oil inventories are right around the 5-year average. So what OPEC's doing now is more of a preventative measure. They want to make sure that oil inventories don't build through Q1 and Q2 and put pressure on oil prices. But if demand stays strong, as we think it will next year, then at some point next year, maybe OPEC will have to open up the taps again, probably towards the second half of the year. Looking at the demand side, it does look pretty positive at the moment for 2019. The forecast is for 1.4 million barrels per day of oil demand growth. But more importantly, there's a lot of new refining capacity coming online next year. And also refineries will have to run at higher throughput levels in order to produce sufficient low sulfur fuel ahead of IMO 2020. So we do think that the demand side for crude next year is going to be very strong. And again, as we get into the second half of the year, that could then encourage more OPEC barrels to come onto the market. But probably what will be a bigger driver of tanker demand next year will be US production and US export growth. The United States has become a very important driver of ton-mile demand now on the crude side. And in the second half of next year, we anticipate that 1 to 1.5 million barrels per day of new pipeline capacity will come online, bringing US crude to the Gulf Coast and making it available for export. And so we do see that US crude exports could rise from about 2.5 million barrels per day now to 4 million barrels per day by the end of next year. And a lot of those cargoes will be going long haul to Asia. So that's going to be a real important driver of ton-mile demand. Also next year, we think that fleet growth will remain relatively low. It will probably be a bit higher than this year. We're forecasting about 3% tanker fleet growth next year, up from 1% this year, but that's still well below the long-term average. And we also think next year that we might see some significant off-hire time as vessels go into dry dock, and a lot of vessels, especially VLCCs and Suezmaxes, will be installing scrubbers, which will take those vessels out of the market for a period of time. So that increase in off-hire time could actually cut that fleet growth by 1 to 2 percentage points. So we do think it will be a very low year for fleet growth. So summing it all up, we do think that the next few months, as we go into the spring, we'll see some lower tanker demand and some lower rates and some more volatility. But we're still very bullish on the outlook for the second half of 2019 and going into 2020, because the demand side looks good. We should see an increase in Atlantic cargoes moving long haul to the Pacific. And I think the impact of IMO 2020 will be a positive on both crude and product tanker demand as well. And so I do think that the fundamentals are set up for a very strong 2019 and 2020, but we might have to endure a bit more volatility and a bit more weakness in the early part of next year due to the OPEC supply cuts. So that's our outlook for the tanker market in December, and we'll speak to you again next year.